This is Sovrun, your guide to financial literacy. Today, we're uncovering the number that every investor looks at first, but most read wrong. A 50% gain followed by a 50% loss. Most people think that's break even. It's not. You've actually lost 25%. That gap between what you think you earned and what you actually earned. That's the difference between average return and annualized return. Return is simply how much your money grew or shrank. Put in $100, get back 110. That's a 10% return. Think of it like a report card. Average return is your GPA. It treats every semester the same. But annualized return is the honest grade because one terrible semester drags your real results down more than one great semester lifts them up. Let's see how these two numbers diverge. Say you had 3 years of returns, plus 15%, minus 5%, plus 12%. For the average, just add them up. 15 minus 5 plus 12 equals 22. Divide by 3, 7.33%. Sounds solid. But for annualized return, we multiply the growth factors. 1.15 times 0.95 times 1.12. Take the cube root, and we get 6.98%. That's a real gap, and it only gets wider as volatility increases. Savings accounts generate about 0.5%, barely keeping pace with inflation at 3%. 10-year Treasuries sit around 4.5%. The Nasdaq 100 is closer to 13%. Faster growth, but a rougher ride. The S&P 500 has returned about 10% annualized over the last century. Here's where it gets real. During the dot-com bubble, the Nasdaq surged 85% in 1999. Then it crashed, down 39% in 2000, and another 21% in 2001. The average return across those 3 years? About 8%. Sounds fine, right? But the annualized return was negative 1.8%. $100,000 became $94,500. That 8% average was a lie. This is why annualized return matters more than any other number in investing. Average return hides the damage of bad years. Annualized return reveals it. Portfolio managers, financial advisors, anyone checking their 401k. If you're not using the annualized number, you might think you're winning when you're actually losing. And return isn't just for stocks. Businesses track ROI on every project. Farmers measure crop yields season over season. Students weigh the return on their education. Follow Sovrun for more financial insights.